Thanks for joining us today on Market Call. I'm Marilla Fernandez. Eric Nuttall with us on the show, partner and senior portfolio manager, Ninepoint Partners. He'll take your questions on energy stocks today. Here's how to reach us. 1-855-326-6266. You can always email your questions in as well. That is Market Call at BNN Bloomberg.ca. How are you? Thanks for coming in.
I'm well, thank you.
Let's talk about energy. We know that the price of oil has kind of settled into a bit of a range. It hasn't done any crazy spikes of late, like it did at the start of the conflict. Markets seem to be looking past what's going on in Iran, but do you think there's going to be a spike again?
Yeah, the market is looking through where we stand today, thinking that the Strait will open up tomorrow, we'll go back to normal. That apathy is creating the most attractive opportunity for energy stocks that I've seen in my career since the lows of COVID. We are down 13 to 14 million barrels per day of Middle Eastern production. When you net everything off, inventories are falling by roughly 7 to 8 million barrels per day. We've already lost 1.1 billion barrels of forfeited production. Even if the Strait begins to open up next month, our math is the world will lose at least 1.8 billion barrels of record production. So it's just a monstrous number. And you cannot lose that amount of production without significantly impacting the oil price. What we see coming is, by July 1st, the world will have lost enough inventories globally such that the global refining system will start to form cracks. There will be product shortages. Already on Twitter, it's quite common. You're hearing about the Walmarts receiving letters from Exxons, et cetera, saying, look, we're running out of lubricants, some motor oils. So it's just starting. And so while there's apathy today, I think it's going to be imminent product shortages that jolts the market out of this catatonic state, because all of the safety buffers that we've had, whether it's releases from the SPR by the biggest magnitude in history, whether it was the last of the ships leaving the Strait that have now reached berth, whether it was bloated inventories coming into the year, that's now all gone. And we're entering into a time of year where demand really starts to pick up as we enter the driving season. So you can't experience, like the last 77 days versus where we're going from here, when we all hope the Strait opens up. Like if it doesn't, it's cataclysmic. All of my best advisors believe that Iran has now figured out that having the Strait closed gives them more leverage than actually having a nuclear weapon, and it's not something they're going to give up. And so the market is completely ignoring what is coming. What is coming is a price spike, because that is the only mechanism to rebalance supply and demand, because we've lost so much production.
As you know, Canadians think, oh, we have a lot of energy in this country, we're going to be okay. I know India last week already started telling its citizens to go easy on the fuel, try and preserve what they can. Mm-hmm. Why do you think, or do you think that because we have that insulation, Canadians aren't feeling it as much yet?
I think we'll be fine from an oil perspective. Refined products, I think we're going to skate by. We're going to pay for it. I've got a family trip in June to Italy. I was told my wife a month and a half ago, I said, like 50-50. I think we'll make it through. But if you've got travel plans late July, August, and certainly Christmas plans, if this does not get fixed, I would meaningfully reevaluate those. The cost of everything is going to go up. And when I see, like, I'm not a broader market guy, but when I see the S&P hitting all-time highs, and the mantra is, well, gasoline is only 4% of the average U.S. consumer. Oil is in everything. Literally everything, whether it's feedstocks, whether it's transportation change, yes, gasoline, jet fuel, everything. And so the inflationary shock coming is going to be absolutely massive. From an investment perspective, what I'm very excited about is that energy stocks, oil stocks, are roughly discounting an oil price of $65 to $70. We think the floor price for next year, when we eventually come out of this, is about $80. And we're going to experience a meaningfully higher oil price than that, I think, in the coming months. We just had one of our favorite consultants that is saying, look, they think the Strait's remaining closed for the next several months. Coming online, their math is July, sorry. Even then, they are calling for only $125 for both Q3 and Q4. And so this notion that we're just going to fall to $60 when the Strait opens up, I think is extremely ignorant, and it is offering a wildly compelling entry point in energy stocks.
Let's take a quick break. We'll line up the first phone call for Eric Nuttall, Ninepoint Partners, taking your questions on energy stocks today. Here's how to reach us again, and we're back with your phone calls and your emails in just a moment. Welcome back to Market Call. We will start with an email from Enzo. He says, there is no doubt The world still needs energy many years to come, with the price of a barrel of oil increasing roughly 50%. The prices of oil company stocks are not increasing nearly as much. Why is that? So what is the expected increase in stock price for comparison to a barrel of oil?
Yeah, so it depends the reason why the oil price is going up. Typically, geopolitical spikes are not awesome for energy stock performance because naturally, if it's up on a geopolitical spike, some resolvement comes, and then you would naturally expect the oil price to fall off. And I think that is a key misunderstanding this time around. Again, this belief that Donald Trump's going to tweet out, Strait's going to open up, we fall back to $60. And it's the magnitude and velocity of what we have experienced and will experience that is teeing it up to be very different. Every geopolitical spike, whether it was Abcake in 2019, whether it was the Russia-Ukraine, IEA, we're going to lose 3 to 4 million barrels per day, and we lost nothing, and oil falls. As an investor, as a commodity trader, you've been rewarded every single time to sell the geopolitical spike. This time very much is different. So our view is what I'm calling the day after, because you don't want to buy an energy stock today. Like, don't say, that Nuttall guy in BNN said oil's going to $200, I'm going to buy. Like, that's not the investment thesis. The investment thesis is the day after, when things eventually do normalize, what does the world look like? And I think that means that given the magnitude of inventory draws that have occurred and will occur, that need to be restocked, and it's going to take 3-4 years to achieve that. The floor price for oil, we think, is roughly 80. We're going to figure it out because there's no playbook, but directionally we think is 80. And in that context, we'll present a lot of ideas today, and we'll give later on in the show. We're deploying our investors' capital, believing that we can make at least 50% at $80 oil over the next 1 to 2 years.
Okay, so you're extrapolating back from that.
Yes.
Got it. Let's go to the phone lines. Frida is in Chilliwack, BC, with a question. Frida, go ahead.
Good morning. I'm interested in your outlook for Athabasca Oil, please.
Okay, thank you for the question. Let's talk about Athabasca.
So Athabasca is one of the 2 remaining mid-cap Canadian oil sand names. We've made generational wealth for our clients with this name. We think the stock is a double from here. Again, that's not a 1-year target, but it's critically important to, like, the analogy I'm using now is, okay, we've made the call, which we think we're correct in. We've positioned ourselves, and now you're riding the bull, and the key is to hold onto the horns and not get shaken off by selling too early. To help you not get knocked off the bull and taking profits too early, we have all of these companies built out over the next 5 years. So the real power and the real wealth creation, I think, in this sector is benefiting from organic growth, but also meaningful compounding of share buybacks over time. So I look at Athabasca at $80 oil. Next year's trading at 6 times. We would say, okay, well, an 8 times multiple is appropriate. That would be roughly 35% upside, get you a $16 stock. But if you look out as they continue to buy back 10% of their stock, and as they're growing their production by about 75% over the next 5 years, I look at a name like this, and at $80 oil in 2030, we've got them trading at 4.4 times. So, I look at that, well, that's more than a double in the share price. So I think in this sector, so long as you can just sit on your hands, that's the strategy going forward, and just let these companies compound out the returns over time. And again, that's at 80. I didn't even reference 90 or 100.
And just to clarify, because we've seen that run up in energy, and people want to know, should I wait for a pullback here, or should I put money in today?
Yeah. Short-term timing is exceptionally difficult. My belief is there are a lot of generalist institutional funds. So they're the guys with all the money. Like, I manage about $2 billion. There's guys managing like 50, right? Those are the guys with the money. For this stock, this sector to really do well, you want those guys to be deploying, and they're not deploying for that reason. They're afraid of, okay, Trump's going to tweet out on True Social.
And everything goes down.
Straight opens up, we go down. My belief is there is a phenomenal amount of buying power now sitting on the sidelines, recognizing what I've talked about ad nauseum about the day after, and things are structurally significantly better than they were 4 months ago. And people are waiting for that pullback. But when you have so many people waiting for it, when you have so much money on the sidelines, I really do question, one, what is the quantum of the pullback? And secondly, where are we pulling back from? My belief is it will be pulling back from a higher level today. So this is a volatile sector. There's a phenomenal amount of uncertainty. If you don't want to make this call, outsource it to somebody like myself. And if not, I just think the long-term upside warrants being exposed today, as long as you can ride out volatility.
So again, it's a longer-term play. Don't try and ride that little up and down. Okay, let's get to the next caller. Rob's in Calgary. Rob, go ahead.
Hi, thanks for taking my call.
Hi, Rob.
I'm a unit holder of the Ninepoint Energy Income ETF. The symbol is NRGI. And I enjoy the income that the fund yields. And at the risk of sounding like a promotional plug for the fund that Eric manages, I'd like to ask him a couple of questions related to that fund. Sure. Specifically, I understand there was a change in the investment strategy earlier this year in an effort, presumably to generate higher return, higher yield to its shareholders. So my questions are you using leverage to enhance the income yields? And if so, what's the exposure there? Sure. And have you been, and then I guess secondly, is the fund's enhanced yield a partial return of unit holder capital?
Got it.
And I guess thirdly, are you hitting your new targets?
Yeah, you bet.
Thanks for taking my call. Feel free to unabashedly pitch your fund, Eric. Have a good afternoon and a wonderful long weekend.
No,
thank you for the question. Okay, three very specifics.
Yeah, and thank you for your business. So in January, we changed the strategy to create more income because it's an income fund. So in doing that, the old way we used to do is we would write out-of-the-money calls on an entire position. So you own a basket of names, you get dividends, you write calls. And if the stock went up by more than 10%, you get called away, and then you just buy back. The new strategy is the same basket of high-yielding stocks, but you're writing, it's called at the money, on only a third of the position, 30%. So our philosophy was we've got 70% offense, can keep running. 30% if the stocks go up, you get called away, you buy back. But in doing so, you're generating a lot more income. And so we went to a 14% yield to book in January. To date, by our estimates, we are over-earning that. So we don't think we're not borrowing on return of capital. It's an honest yield of now we're yielding 12-ish% because the unit has gone up. We're up roughly 25% year to date.
Okay. So that was the change there. Let's go to the next caller. JC's on the line, North Bay, Ontario. JC, go ahead.
Hi, I'd like to ask about Spartan Delta. I've always preferred the kind of mid-cap range as well. A lot of them are getting taken out, though. Do you think this is one to put some of the money into?
Thank you for the question.
We own a lot of it. We've done exceptionally well. Our cost on it is roughly $6.92, so we're up 99% on it. And I think, we own about 4%, so that would put us as one of the larger shareholders. What we like is Fotis and his team were extremely early movers to identify a massive, massive resource in the Duvernay. It is, I wouldn't call it an emerging play. It's really an emerged play. They really cracked the nut on how to frack these wells economically and get really, really good results. So the profitability of these are phenomenal. They have over 550,000 net acres. If I were to look at it as a snapshot of today on a pure price to cash flow basis, I'd say it's approaching fair value. We'd say, okay, 6 times, it's trading there. So again, it's a name where you've got to look out a couple of years. We would have it sub 4 times on 2030. And to the caller's question, the scarcity value of large contiguous blocks in highly economic plays at a time when U.S. shale production growth is largely coming to an end. The strategic value of those assets is going up and going up a lot. So with ARC being taken out by Shell, as an example, there are very few names left in Canada where we think you could have a company come in and just take them out. We don't want that. We were publicly opposed to MEG getting taken out by Cenovus. We were forced out of it at 38. It'd probably be a $60 stock today. We were publicly opposed to Novista being taken out by Ovintiv. So you're seeing M&A already. We never buy a name. That's never part of our investment thesis. But you're kind of wanting to buy quality assets, which by extension are probably going to be attractive to somebody down the road. We just think it's going to be at a higher price. And we hope that the team will have years to further delineate, expand the resource to maximize how much they could potentially sell for.
I was going to say, but you see it definitely being an acquisition at some point.
We think the stock is a double over the medium to long term.
Let's take a quick break, then we will be back with Eric Nuttall, Ninepoint Partners, taking your questions on energy stocks. Stay tuned. Welcome back. We're going to go. Glenn is in Collingwood. He's in Collingwood, Ontario. He's got a question today for Eric Nuttall. Glenn, go ahead.
Good afternoon. Eric, what is your current opinion on Vermillion? I see that Vermillion has fallen off, but Whitecap has stabilized. Thanks for taking my call.
Okay, thank you for the question.
I still view Vermillion as a work in progress slash value trap. I think the last show was the first time in many years where we're a little more positive. They're starting to rationalize off their geographical exposure. I've said in the past, like anytime I need a world atlas to figure out how many different operating areas they function in, it is probably not great for the cost structure and strategic focus. So I think you're seeing them dial that back. It's almost returning to Canada in some ways. And for that, if you're buying it for oil exposure, we think that there's better oil names to buy. If you're buying it for their Montney natural gas, we think there's better Montney natural gas names. So while the stock screens fairly inexpensively, it's lacking the catalyst and it's lacking the sizzle for, I think, a fund manager to give it a look relative to other opportunities that are available today. So I would not, I don't own it. We only own 11 names in the fund, and I wouldn't own it.
Let's move on to Chris in Delta, BC, with a question. Chris, go ahead.
Oh, good morning, Morel and Eric. Thanks
Chris.
for taking the call.
You bet.
Yes, Eric, I have an honest question, too, not promotional. If somebody comes to your fund with, say, X amount of capital, is it automatically invested 100% and then based on whatever the fund is in cash, it just buys that? Or is it, because
Yes.
I like to buy in thirds, so that would be my question.
Yes.
As someone coming to you brand new, no relationship at all. And then my question's on Paramount Resources. Thank you, and please keep appearing on all the channels. Bye now.
You bet. So yes to your first question. You're effectively just buying a unit in the basket of names. We only have about 4% cash right now. So you're effectively, if you're deploying today, you're getting exposure. Paramount, we do like. Jim Riddell is a awesome finder of resource and then a great seller of resource. So they recently sold the majority of their assets to Ovintiv. They've got net cash on the balance sheet with which they're quickly spending to delineate the remaining asset. Well, results remain very good. We prefer kind of names that have a little more oil balance to them. Like they're about 42% condensate, some NGLs now. So call it a 50-50. So while most of the revenue will be derived from liquids, we're pretty negative on Canadian natural gas pricing. We just think there's too much good resource where the economics are driven off of the oil price and not the gas price. We have LNG Canada at full ramp at 2.1 BCF a day, and the AECO price is like at pathetic levels. So we really want to hone in on where do we get the maximum amount of liquids potential. So I have nothing against Jim. He's a great guy. He's created a phenomenal amount of wealth. We think the resource base is very good. It's just not oily enough to hit the list. Again, we only own 11 names right now, so it's a very, very focused basket. My goal is how do I maximize upside capture for my clients in what I think is a huge opportunity when the rest of the market is blind to it. This just does not hit that hurdle.
All right, let's go to the next caller. Brian is in Victoria with a question today. Brian, go ahead.
Good morning, Eric.
Hi, Brian.
My question's on ARC Resources. I own quite a bit of ARC Resources, and I'm wondering about the takeover bid and whether, if I accept it, it's worth holding Shell shares.
No,
all my Canadian holdings are Canadian right now.
Sell it immediately.
Why is that?
Shell. So why is Shell buying ARC? We think that Shell will go ahead with phase 2, LNG Canada. There's actually rumors that maybe there's a phase 3 potentially in the works. We will see. That's not being widely spoken about. Shell right now is symptomatic of the problem with the global super majors. They are short reserves. They're sitting on, I believe, their lowest booked reserves in its corporate history. So you look at the largest companies, literally in history, they've never had fewer barrels booked. So a global average now is about 8 to 9 years. Well, we think demand for oil is going to grow for the next several decades. So why are we seeing more activity coming to Canada just as they came and bought ARC? Part of it is replacing their inventory base. So why would I want a company with 8 or 9 years of booked reserves? There are certain elements of European philosophies, which I'm not hugely supportive in terms of where they allocate free cash flow instead of doing share buybacks, et cetera. And you can just get way better names. So we'll have a top pick later on. It's a Montney/Duvernay name where I would sell this today, now, hold the cash, and then I'll tell you what that is in about 30 minutes' time.
Okay, Brian can hang on for that. Let's go to Steve in Richmond Hill, Ontario. Steve, go ahead.
Yeah, good afternoon. Thank you very much for taking my call.
You bet.
At the end of March, I took a position in Surge Energy. Tell me a little bit about where you think that just came from and where is it going to head off. I'm up about 5%, and I'm happy. I just don't know whether I should hold or buy more.
Tell me a bit about Surge.
Yeah, so Surge is a small cap, which is the problem, but a small cap, medium gravity oil producer that continues to just crunch it out quarter after quarter, year after year. They continue to drill very good wells. The stock typically has been an underperformer because of, I think, market cap relevance. It's just too small.
98 million, something like that?
No, it's 994 million.
Excuse me. Yeah.
So it's pretty tiny, enterprise value 1.1 billion. So yes, I can tell you it screens well at 4.3 times. The dividend yield is very attractive, 5.1%. Free cash flow yield forward, it's blah, blah, blah. Like, sure, I can give you theoretical share price, but unless there are, I would suggest it's helpful, at least, to have institutional investors have an interest and want to take a stake. It just is not there yet. And so, again, I own 11 names. This isn't one of them. I think you can make more money in other names that have more relevance, larger market cap, equally as good reserves and production-based inventory, et cetera. And we'll give you some ideas later on.
All right, let's take a quick break. We will get to past picks from Eric Nuttall when we come back. Stay tuned for that. Let's get to some past picks from Eric Nuttall from May 20th of last year, so just under a year ago. Expand Energy was the first pick, EXE on the NASDAQ at 114.92, US down to 97.34, 15% drop, total return is 12 drop. What happened with Expand? Tell me a bit more about that.
Yeah, so really nothing other than the natural gas price. They are also searching for a CEO, which is this is the largest natural gas producer in North America. So it's kind of odd that they would go so long without a CEO. The CFO was asked to leave, I believe, and then the CEO, there was a difference of opinions in terms of strategy. So that's weighed on it a little. We don't own it. We sold 104, 105-ish. If you're bullish gas, that's an if. If you're bullish gas, this is still a really, really great horse to ride. We're using 350, so our gas deck would have come down when we made the suggestion from 4 to 350. Mother Nature in the winter did not cooperate in terms of it wasn't that cold. I know it felt cold, but North America-wide, it did not. We've also seen irresponsible behavior from the part of private natural gas companies that, similar to what happened in Canada, they're front-running the incremental build-out of LNG in the United States. So they're going to go from 20 to about 32 BCF a day. Similarly, in Canada, we went from 0 to 2, and the price went down. Well, why? Well, all of these guys grew supply in anticipation of that. You're getting that. There's AI data centers at 6 to 14 BCF a day of long-term demand. But we're just, again, I believe, outside of the COVID lows, this is the most excited I've ever been about deploying capital into oil stocks just because of the quantum of misunderstanding in terms of where we're likely to be heading, not just in the coming days and weeks, but quarters and years. And so that's really where I want to focus my clients' money on. There's nothing wrong with Expand. It's trading at 4.3 times at 350 gas. 7 multiple, that's theoretically 70% upside. We're just not there today.
Let's get to your next past pick. New Vista NVA on the TSX at 14.08. Last May, now to 19.04, 35% upside, a 35% total return. Have you stayed with New Vista?
Well, they got bought by Ovintiv. So that was late last year. We do own Ovintiv. It's one of the 11 names. I actually met with the team. I was down in Houston for 2 days earlier this week. So why don't we touch on Ovintiv? Because if you own Avista, either you're in cash right now or you took Ovintiv stock. So we like Ovintiv because you've got exposure to 2 of the best plays in North America. You've got the Montney in Canada. You've got the Permian in the U.S. You've got 10 years of Permian. You've got 20-plus years of Montney. They're deleveraging. So right now they're paying 50 to 100% of free cash flow back to share buybacks. We think it's going to be about $1 billion of buybacks this year at a minimum. There's a bias to that going up as they continue to delever. And I look at it at, again, 350 gas, $80 oil. It's trading a sub 4 times. It's a $16 billion business, so it's big enough to be relevant. And from a free cash flow perspective, we would have it going from a 14% free cash flow yield next year to almost a 16 in 2030. So it's this combination of modest organic growth, ongoing meaningful share buybacks. We think that as energy becomes more relevant in the U.S., where now it's only about 3.8 roughly of the S&P 500. When it becomes more relevant and there's more eyeballs looking at the space, this is a name big enough to attract capital, and you'll get multiple expansion to a 6 multiple. And at 6 times at $80 oil, we'd get about a 40% upside from here.
All right, let's get to your last to pass pick from May of last year, Tamarack Valley, TVE, TSX, 436 at the time to 1290 today.
Look at that one.
Yeah, 196% upside for a return, 199 total return.
Yeah.
Tell me a little bit about what happened here in the last year.
So we like it more today, up 199% than we did then, and we liked it back then. So what they have done is they've proven that the years of mediocre share price performance as they were aggregating resource in the most economic play in North America, in the Clearwater, has paid off. There was some trials and tribulations along the way, but their strategy was proven to be effective. So they now have at least 20 years of drilling inventory. But what's really happened in the last year has been proving just how effective water flooding is working. And so that's just, you take a well, it's produced oil, then you start injecting water, it increases reservoir pressure, or you take an old well and you do that. They have wells going up like 10x, and the response time is super quick. So the economics of this are just absolutely phenomenal. More economics, more margin, more free cash flow, more buybacks, more dividends. So we've got it at 6 times this next year, falling to a 4x in 2030. We think a 7 to 8 multiple is very reasonable. You're getting 50% kind of 1 year upside, but this is, again, sit on your hands, let it play out. We think the stock is a double over time.
Let's take a quick break on that note. We're going to be back with Eric Nuttall taking your questions today. He's with Ninepoint Partners, and he'll take your questions on your energy stocks. Back in a moment. Welcome back. Daniel is in Markham, Ontario. He has a question today for Eric. Daniel, go ahead.
Hi, Marilla. Hi, Eric.
Hey, Daniel.
My question is on precision drilling. What's your playbook on buying oil services companies, and would you buy service companies? And also, Eric, one of the best guests on Market Call.
Well, thank you.
Thank you. Great question. Do you sort of expand your portfolio to services?
We could. Again, I met with both offshore and onshore drillers and pressure pumpers in Houston a few days ago. So I think I've got a general sense in terms of where activity is going, and it's going up. We would expect pricing to be up 5 to 10% later this year and bleeding into 2027. We do think that U.S. shale producers are going to chase the oil price a little. We'll get some modest growth. So that's bullish for the service sector. My question is, that I pose to myself is, okay, you think that there's this huge opportunity in oil. What's going to move first? What's going to move the most? And then you can think about secondary and tertiary ways to benefit from that view. I believe today that the primary vehicle that I should be using, or the only vehicle, is pure play oil producers, primarily in Canada. We do have some U.S. exposure as well. Services will go up. Everything is going to go up. What's going to go up the most? So, Precision, I've owned 9.9% of this company in the past. We did very well. I think we bought at 60. We sold at 95 or 100. We would have bought other stuff with it since then. It's a well-run company. Their former CEO retired. The old CFO took over. So you've got seamless integration. So it's a great company, and they've got good exposure to some great, the key basins in North America. I just think that there's more money to be made in the producer than there is in the service company right now.
Let's go to the next caller then. Gordon's on the line in Calgary. Gordon, go ahead.
Thank you for taking my call. I would appreciate Eric's view on whether he thinks Kelt exploration, symbol KEL, has similar attributes to ARC, which was taken over by Shell, and whether he has any information on their reserves. I'd appreciate that. Thank you.
Thank you.
Really,
yes.
Yeah, bye.
Thanks, Gordon. Okay, so it is a similar concept. They didn't over-promote an asset and then have it fail. Kelt has done a great job. They've, again, Dave Wilson, Sadiq, Dave's a really good finder resource, just like Jim Riddell at Paramount. They go out, they buy large, under the radar, large sections of land, and then continue to delineate it over time. It's never they don't do buybacks. That's not their thing. It's all about delineate the resource, grow reserves, and then sell one day. They've got two main assets within the company. Timing the sale, timing of the sale is very, very difficult, and that's why we never put M&A in our investment thesis. We just try to buy good resource. It's just not a name that's, I notice, they've got gas, it's a little small, it's tight float. We just don't own it today. So if you're looking for M&A, I think there are other names that are going to benefit more near term.
He had a question about reserves as well. Do you know how their reserve?
Yeah, so they have 5 years of PDP, 16 years of booked, according to, now that might be stale, so I did.
Okay.
No,
Roundabout.
sorry.
Let's go to Brian's email. I'd like your thoughts on Prairie Sky as a long-term hold. Let's talk about Prairie Sky.
Yeah, so Prairie Sky is an exceptionally well-run name. So it's a royalty co. So they have, this was a spin out from Encana / Cenovus years and years ago. It stumbled for a while because I think it came out at a pretty rich valuation. They're now back to, I think that should be an all-time high today, it looks like. My struggle has always been, okay, what's the fair multiple on a royalty co? So the others I can use free cash flow, I can use EV to cash flow. For these guys, like they're trading at 19.5 times this year, 18 times next. I kind of struggle, like, what is fair value? You can't use dividend yield because the dividend yield is only 3%. Is it free cash flow? What's a 5% free cash flow yield? That doesn't scream to me as overly compelling. So then the thesis is, well, they have all of this land. They've got a lot of exposure to emerging plays. They've got good Clearwater exposure. They've got multilateral, conventional heavy oil exposure, all that stuff. But it's just, I find it difficult to ascribe kind of what I call 4P value onto that. So it's not a name that we own in the main fund. We do own some in the income fund because, again, we're making our 14% through our strategy. But again, if you're very bullish on oil, the royalty cos are not the way to go. It is the pure play E&P name. Maybe you get a little refining exposure, maybe you don't. I think those are the names that are going to perform the best over the next 6 months to a year.
And you're right, high price today, getting up to that range. Let's go to Frank on the line in Toronto. Frank, what's your question today?
Yes, I have a question for Marla. I have a question for Eric. I always liked his great guest on BNN, also his articles on Global Mail. I have a question for Baytex. I have two questions. One regarding Baytex, what's his stand on it? And two, he mentioned the floor of $80 a barrel for oil. In his opinion, what is the best optimization in terms of overall economy? Thanks very much.
Thanks for the question. Okay, well, start with Baytex.
Yeah, so the second part is kind of moot. What you want versus what you get, I think, are going to be two very different things. I think the sweet spot at 80 to 100, the economy can function just fine. On inflation adjusted, that's a very cheap price for oil. It's enough for companies to generate enough free cash flow to benefit their shareholders, keep them happy, and also match organic growth to satisfy global demand. That's just not what I think we're going to get. I think we need to get a spike, and we've touched on why. Baytex is a name where we're not quite there in size yet. We've met with the new CEO. We've known him for a while. He was the COO. He is now taking, so just to set the table, this company really stumbled with an Eagle Ford acquisition. It was not what they wanted or what they thought it was going to be. Eric Rieger moved on. He retired from the company. Their CEO became the new CEO. So very honest, capable, hardworking guy who's now trying to insert his influence on corporate strategy. To my knowledge, he's not now taking a salary. He's taking all stock and comp. So that's a really, really positive thing to see. They do have good exposure to highly profitable plays in Canada because they've now repatriated, which I like that as well. We're just not fully there yet on appreciating what their true running room is in their inventory base. So it's a work in progress for us. It's not a yes, it's not a no. They say they have at least 10 years. We're just trying to continue to do work to validate that internally as well. So, but it checks a lot of the boxes. It's trading at 3.7 times at $80 oil. They have net cash. They're going to use that for buybacks, probably some M&A, I would speculate, too. There's probably opportunities out there for them for their specific multilateral expertise. So it's a work in progress. Time will tell. I'll know more in the coming months.
Let's take a quick break on that note. We'll be back with Eric Nuttall taking your questions on energy stocks in just a moment. Welcome back. Nicholas is on the line in Toronto with a question. Nicholas, go ahead.
Hi, Eric. Big fan of the show. I noticed you own Suncor in the fund. What sets Suncor apart from the other big large cap producers like CNQ or Imperial? Thanks.
Thank you for the question.
Yeah, so you've got 4 to choose from. I'll talk about one in a few minutes' time. So we own 2 of them. We like Suncor a lot. I think Rich Kruger is a stud. Like, this is the fastest corporate turnaround in Canadian history. What he has done, he has just shot the lights out to improve that culture, to have it from like a really bureaucratic, almost government-run entity to now they actually feel like winners and they're proud to come in to work. And you feel
not an easy thing to do.
No, and especially in the timeline. So it's amazing. He's done a great job of taking the market's focus off of base mine depletion, which is a large area, which they're going to run out of ore, to focus on other areas, to have the market believe into the prospectivity of their deep, deep inventory base. We think that oil sands are a gift from God for Canada, and they are going to generate gobs of free cash flow for many, many, many decades to come. And you're paying a discount to the global super majors. You're paying 6.1 times cash flow versus an Exxon, a Chevron, a Oxy, et cetera, with less inventory depth. And then the final thing is, they're part of the stream that they sell, synthetic crude, is trading at a material premium. So that's kind of a short-term dynamic too. We think it should trade at least 8 times. That gives us about 50% upside from here if you look out a year to 2 years. And again, our bias is for oil to go up much more than that. So you've got a great team, you've got an amazing resource, you've got ongoing meaningful share buybacks, a cheap valuation. CNQ we're not fond of today. It has underperformed, so I think our call on that has been validated. It trades at a bit of a premium to Suncor, 1 turn 7 times. You do get a fair amount of natural gas as well, and we're just not positive on Canadian natural gas. We think that it is, the economics of most activity today are driven off of the oil price. You've got 2 little companies, a Birchcliff and a Paramount. Between the 2 of them, they can bring on a BCF a day pretty damn quickly. And, gas could be at 0 and they'll still bring on that volume. So I want as pure play exposure as I can. Imperial is a mystery to most in terms of valuation. It trades at 10 times. That's actually come in a little. It used to be at 13. It's heavily shorted, so those guys have just had their face ripped off. But we don't find the valuation nearly as compelling relative to a Suncor or a name that I'll touch on in 5-ish minutes' time.
Okay, let's go to the next phone call. Steve on the line in Vaughan, Ontario. Steve, go ahead. Steve, are you there?
Hi, I just want... Yes, I'm here.
Go ahead.
Okay, I just wanted to thank Mr. Nuttall for all his advice and expertise. My question is about Tenaz Energy Corporation. I just wanted to see what his assessment of that company is. Thanks very much.
Okay, thank you for the question.
Yeah.
I call it Tenaz. Is it
I
Tenaz?
call it Tenaz too.
Okay, go ahead.
I hope we're both right.
We'll see.
So you get pure European natural gas exposure at a time when we've lost 20% of LNG flows through the Strait of Hormuz. My own view is the strait is going to remain shut much longer than consensus believes. Even if it doesn't, if it opens up, tomorrow, we still have the biggest crisis of our lifetime. So you kind of get free optionality to that. It trades very inexpensively on strip pricing, kind of a 3 times forward multiple using TTF. So that's kind of European natural gas pricing. You've got a team that we have known from their Vermillion days. Full disclosure, we tried to find stock in this name and we couldn't find it. And so we identified the opportunity. There are times when you just can't find adequate position size. This is one of them. So, I'm guessing Steve doesn't have that issue. If you own it, I would just let it continue to ride because it's a name where we would have it sub 2 times about 4 years out. I like the macro thesis around European gas. You've got the epicenter of eco-wokeism on planet Earth, the Europeans. They're finally realizing, oh, shoot, maybe we shouldn't have blown up, all of our nuclear plants because now we're short energy. And that's like a little too late. So what do you got? You got to get gas. So this is one of the pure vehicles to play it with a proven team, a lot of resource depth, exploration upside, and this cheap on current production.
All right, let's take a quick break then. We're going to get to new picks from Eric Nuttall when we come back. Stay tuned for that. Join us on Tuesday for Market Call. Rebecca Telscher on the show, portfolio manager at New Haven Asset Management. She'll take your questions on Canadian stocks. We're off on Monday, so we're back on Tuesday. Let's get to new top picks from Eric Nuttall. We're going to start with Cenovus Energy, CVE, on the TSX. What is it about Cenovus that you like right now?
This is a set it and forget it type of name to get meaningful exposure to a bullish oil thesis. Again, we think the new floor for oil is $80. We're biased higher than that in the years to come. With Cenovus, you get both downstream exposures, meaning refineries. Refining margins right now are at record highs. We think those will stay higher for longer, given the amount of capacity that has been hit, both in Russia and Middle East, et cetera. Then you get top decile oil sand assets, plus some production now off the East Coast because they've got West Rose coming online. They just reported yet another record quarter. I really like the management team. John McKenzie is a great spokesperson for the space. He's one of the few that publicly came out and talked about the stupidity of carbon taxes and why it makes us less competitive. This name trades at 5.7 times cash flow at $80 oil. We think that it should at least trade at its global peers, which would be closer to an 8. At $80 oil, we think it's about a $66 stock a couple years out. And if you're more bullish on the oil price, or you want to give them the benefit of more time, we've got them compressing it down to about 4.4 times in 2030. So that's as they continue to buy back about a third of their stock over the next 5 years. So again, you compress your multiple to 4.4. We think fair value is 8. We think this stock is ultimately a double from here with the passage of time at a flat $80 oil price.
Let's get to your next pick then, which is Strathcona Energy. That is SCR on the TSX. I remember when they bid for MEG, and that got a little bit back and forth. You like this moving forward. They did have that big dip at the start of the year.
They did. So that was from them paying out a special cash dividend. As they sit today, this is the highest beta name to a bullish oil thesis that I can find on planet Earth. We acquired a pretty meaningful stake. We're up $88 million in about 3 months' time. We think the stock has a lot of running room to go. They did very good counter-cyclical acquisitions, acquiring a phenomenal amount of resource at a time when the strategic value for long-dated reserves has meaningfully gone up. We think will meaningfully go up further. They are growing their production by about 45% over the next 4 years. While doing so at $80 oil, they generate about $900 million of excess free cash flow that they will pay out every year around Christmas time in the form of special dividends. So that's a 9% yield from the specials, about a 3% base dividend yield, plus you're growing your production by almost 50% over the next several years. When they get there, they can then sustain that level for 40 to 50 years. And once they reach, if that is ultimately their plateau, we think they would be able to pay us a 16% dividend a year for 50 years at $80 oil. So to us, that's moderately compelling. We've done well. We think we're going to do even better. Short-term valuation, we say, okay, 7 times. That's like a $66 to $71 stock. That's 50% upside. But we think the stock over time can do much, much better than that.
Okay, let's get to your last pick, which is Whitecap Resources, WCP on the TSX, which I've heard you talk about before. You really like Whitecap, but remind viewers why.
Yeah, and it continues to do well. It's probably hitting an all-time high as we speak. We still think it's meaningfully mispriced. This is a company that has top decile assets in the Montney and the Duvernay. If you own ARC paper right now, you should be selling it, in my opinion, and buying the stock. It will be the biggest recipient of fund flows, as the institutions at least have been doing that. We like it because they continue to beat quarter after quarter after quarter. You've got a CEO that has one of the most aggressive insider ownership and ongoing insider buying of any company that I follow in Canada. It's trading at 4.7 times cash flow at $80 oil. We think fair value is at least 7. Because of the inventory depth, this is a name which hopefully not anytime soon, but we think could be attractive to. There are rumors that there were more than one entity, more than just Shell sniffing around as of a year ago. So it was Stampede of last year where that really started to become a theme. We think companies like Total or others may be assessing Canada and looking for inventory. And we think that Whitecap is one of those names that would be obvious. We don't want these companies to sell. I do not want to wake up again for the 5th time now to a 30% premium when I think a stock can double over time. My clients are patient. I'm patient. That's where you make the real money in the sector. But you've got that as optionality. So we think it's 7 times at $80 oil. You've got 60% upside from here over the next couple of years. And ultimately, we think the stock is worth a lot more than that with the passage of time.
Okay, so we'll watch. We'll see what happens. As you mentioned, deals are being made. So might be a takeout sooner than later. Let's leave it there. Thank you very much for coming in. Good to see you.
My pleasure. Thank you.
Have a good long weekend.
Thanks very
and
much.
Thank you very much for watching today. We'll see you back here again on Tuesday.